Coming up in today's show, the US economy grows faster than expected, jobless claims drop lower than expected, the Dow ends its longest winning streak in over 30 years, a bunch more earnings out today, and the big bearish engulfing patterns across the charts today. Hey, what's up guys? Welcome back to the Click Capital Daily Show. My name's Jared and another interesting day in the markets today. We're getting into the thick of earnings seasons and we had a slew of economic data out, which I'll get into in just a bit, so stick with me today. I've got an interesting one for you, and I'm going to get you all up to date on what's happening out there in the markets. So apart from semiconductors and Meta, it was mostly a bearish day out there. We saw quite the reversal after gapping up early in the morning, and it's created what's known as a bearish engulfing candlestick pattern, where we've gapped up year-to-date highs and then sold off swiftly and finished below yesterday's close. And we can see this pattern across the markets. Here's the equal weight S&P 500, the Nasdaq, the Dow Jones, mid caps and small caps as well, all displaying these reversal patterns. And I'll get more into these chart patterns later on in this video, so stick with me and I'll take you through all the most important news out there today. And so it looks like the US economy is escaping fears of a recession for now, as we just got the latest GDP number out showing that the gross domestic product grew at a seasonally and inflation adjusted 2.4% annual rate in the second quarter. That was well above the 1.8% analysts were expecting, and also above the 2% growth rate we got in the first quarter this year. And here's a chart of the quarter over quarter GDP growth rate annualized. You can see in 2021 there was that big bounce back after 2020, and then that came off hard going into 2022 once inflation started to really bite in the economy. However, the economy has been holding up pretty well these last couple of quarters, and the forecast going forward is that it will drop down to 0.59% in the third quarter this year and into negative growth in the fourth quarter, but just managing to escape the technical definition of a recession, which is 2 consecutive quarters of negative GDP growth, and then start getting back to growth in 2024. And so we're seeing the US economy hold up pretty well, and that's thanks largely to a tight jobs market with near record low unemployment rates. And we saw that again with jobless claims coming in a bit lower than expected at 221,000 versus 235,000 expected. And that's another downtick from last week's claim, which came in at 228,000. So in a logical world, one could expect that higher than expected economic growth and data would be a good thing for business, and the valuation of those businesses and the stock market should increase. However, like we saw in the price action today, it appears the bulls are worried about that growth, and we saw that by the Dow snapping its longest winning streak since 1987 and creating those big bearish engulfing patterns. And that's because it looks like the market may be starting to get worried about another second hike here, currently priced in at a 22% chance of happening in September and a 30% chance that it will happen in November if we don't get it in September. And that number's been climbing steadily lately. And we can see that in the price action of US government bond yields, with the 2-year coming back to year-to-date highs a bit above 5% and a bit more steepening in the curve today, with long-dated bonds increasing even more, with the 10-year yield now back above 4% and not too far off those year-to-date highs at 4.10. We can also see those inflation expectations increase in the price action of the TIP versus IEF spread. And so looking at that price action today, with SP 500 rejecting off this resistance zone and closing down near its lows, there could be signs that the stock market may be starting to get worried that the Fed isn't quite just done yet. They still might have another hike left in the bag, and who knows, they might have some more after that as well. And so that positive economic data and growth wasn't enough to overwhelm the other big data point we got out today, and that was talk of a Bank of Japan policy tweak. And that's basically them loosening the cap on their long-dated government bond yields that they have a yield curve control policy with, and basically allow their own yields to rise. And since there's a lot of Japanese money out there and they do hold a lot of US bonds and stocks, the reaction was that big Japanese investors may pull out some of their US assets and bonds and invest in their own backyard where they could get a bit better rate. And so no doubt that helped push yields a bit higher today, which also caused a bit of an exodus out of long-dated treasury bonds. We can see that in the TLT dropping down almost 2%, back down into the support zone just above 99 here. And this is a level where it's previously bounced a few times. However, if yields keep climbing, then it may fall through the support zone and we may come back down to test those low 90s that we saw in October last year. As technically speaking, it does have a bit of momentum there, with the biggest down day on the most amount of volume we've seen in quite a while. High yield bonds didn't escape that dynamic either, also putting in a big bearish engulfing pattern on volume, and similar story in investment grade debt coming off quite hard as well. But those high yields actually helped the dollar firm, coming back up to its 50-day VWAP on volume, and that stronger dollar caused commodities to come off a little bit here today. However, as I speak, we appear to be getting a little bit of a pop here in gold, up 2% to 1986 an ounce, and crude's been managing to trade really well, to just below $80 a barrel and a pretty strong short-term uptrend here. However, we got a little bit of a pullback in agricultural commodities today, except for orange juice, which did tick up to another all-time high today, but you can see we're pretty stretched up here and starting to get some overbought reversal signals come in. And just to give you a few bullish viewpoints on the market today, we have a fund manager saying it's a great time for bulls. Soft landing views solidify US stock market. He went on to say trillions of dollars that have been cautious now may be deciding to come back into the market. He said the math is now soft landing or no landing. At least that's how the markets are going to treat this. It feels like just a great time for bulls. The combination of an unexpectedly benign CPI number, a good GDP report, still strong employment, and a strong consumer is adding up to the realization that we may not have a recession. That is the most important new news and takes the key bear argument off the table. And he does make a good point. The economy is growing faster than expected and has been defying the most aggressive Fed rate hiking cycle in history. But we are seeing the economy hold up, not only in the GDP growth rate numbers coming in today, better than expected, and initial jobless claims coming in lower than expected. We also saw durable goods jump a lot higher than expected, 4.7% month over month. So there is still a lot of consumer and business spending going on in the economy, and it doesn't look like those higher rates are hurting too much just yet. And that's probably what's going to give Jay Powell the green light to go ahead with some more hikes and gives him some room to cool the economy without going into a recession, and probably more importantly, prevent it from overheating again and seeing inflation tick back higher. If we get a higher CPI number come in, that should really set yields off higher and stocks potentially lower. Also out today, we had the ECB with their interest rate decision. They increased 0.25% as expected to 4.25. Then tomorrow to finish out the week, we got some GDP numbers coming in from Europe, along with some inflation CPIs, and then in the States, some PCE price indices. We've also got another bull out today saying that AI gold rush makes today's stock market look more like the early days of the internet boom than the peak of the dot-com bubble. And that's Wedbush analyst Dan Ives, who says the AI gold rush is just getting started and compares today's market to more like 1995 than 1999. He said big tech earnings has been a flex to muscles moment for the bulls, and the fundamental growth stories are now inflecting into the second half of 23 and 24 with an improving backdrop and the AI revolution just starting to kick in. He thinks Microsoft will hit $3 trillion valuation over the next year. Another news out today, we had a bunch more earnings come in, with one of the biggest being Ford raising their full year guidance after a pretty good beat. They came in with earnings per share of 72 cents versus 54 cents expected. There's a 32% beat. Getting a bit of a muted market reaction to that, and they did say their EV adoption is taking place a bit more slowly than they expected, in part because of higher costs. Also out with earnings today was Enphase Energy, which came in with a solid beat, reporting second quarter net income of $1.09 a share, compared with 54 cents a share in the year earlier, growing earnings more than 100% and beating expectations of $1.28 a share. However, the market's selling them off hard after hours, down almost 13%, and that's because they gave forecasts for Q3 below what the market was expecting. However, they also announced a share repurchase program, and out of all the semiconductors and solar stocks, this one continues to be the weakest. However, it could be undervalued because our stock fair value indicator has it at 211. We're currently trading at 145 in the after hours market, and this company has been seeing really strong year-over-year revenue and profit growth as well. Also out with earnings today was former industry leader Intel, coming in with a surprise earnings beat on PC and data center sales, reporting second quarter net income of 35 cents a share versus a loss of 11 cents a share a year ago, and significantly beating what analysts had been expecting them to report a loss. They actually came in with 13 cents of positive EPS, and the market's marking them up 8.4% after hours as I speak. Even that big bearish engulfing pattern in the markets today couldn't drop fear and greed index out of the extreme greed zone, and was a very busy day in the options market for a Thursday, coming in a bit over 50 million contracts traded, 56% of them calls, and dark pool traders continue to pull back from this market, and still no interest from corporate insiders in buying their own stocks. Okay, back into the charts, and we put these big bearish engulfing patterns on today after we've just been grinding high this last couple of months on really low ranges and volatility. So let's have a look under the hood at all the categories and individual markets to give us more clues on where we could be going next. And just looking at international stock indices, we can see Canada's TSX. It's done a bit of a reversal pattern here off this resistance zone. The UK FTSE closed early, so they probably haven't fully priced in what's happened in America yet, but it looks to be topping out. Germany's DAX index has actually traded up close to all-time highs here, in contrast with the rest of the world. China's A50 index looks to be stalling out a little bit, and the Nikkei is still consolidating at its 50-day VWAP. The Aussie 200 market is closed when the American market is opened, so that will probably open a bit lower today, but it did put in a bit of a shooting star reversal candle yesterday. And we saw a little bump up in the volatility complex today. VIX 9-day shooting up 14%, and the VIX 30-day shooting up almost 10% to 14.4, and kind of giving the same look as the stock market with a potential reversal signal. And we can see that in the volatility of volatility, the VVIX index, showing that volatility pricing is starting to move around a bit more, and the volatility risk premium jumping to 6 points above realized, and a bit of a jump in the skew index just under 148 now. A little bit of a sharp pullback in stocks above their 20-day average to 65%. Oddly enough, we still got 135 NYSE stocks breaking out to new all-time highs and 83 on the Nasdaq. And growth versus defensive sectors held up a little bit, as did high beta stocks versus volatility. And we've already gone over bonds and the dollar index, with Bitcoin still just coiling up at its 50-day. We've already had a look at commodities and over to stock sectors today. Still getting those bullish reversal signals on the cannabis ETF, MSOS. We'll see whether this big support zone can hold down here. And just looking across the sectors, it was only semiconductors and communications on the back of Meta that finished the day higher. Other than that, it was all red across the board. Gold miners coming back down to their 50-day VWAP. And one of the biggest losing sectors today was REITs on a huge bearish engulfing pattern. And even the defensive sectors, healthcare, staples, and utilities were weak. And just looking at our sector trends table indicator, you can see how quickly the market has changed up the front here in the immediate term trend, with now most sectors below their 5-day moving average and almost half of them below their 20-day moving average. But we're still in medium-term uptrends and long-term uptrends, as we can see here in these two columns. So going forward, we'll see whether these sectors can defend their medium-term 50-day moving averages, and this is just a short-term pullback, or are we going to get a bit more of a medium-term correction in the market? Over to popular stocks, and we're getting that reversal coming out from BlackRock after bouncing off this big resistance zone and these reversal signals. JP Morgan as well stalling out a little bit here. A little bit of a pullback in Apple, but still holding this really tight trend line that's been in place almost all year. And this time next week, we'll have earnings out from the big guy itself. However, the second biggest stock in the market and one of the most loved stocks out there, Microsoft, getting some damaging technical price action here. Getting a lot of volume, closing below the 50-day VWAP. And that was triggered ever since they released their earnings a couple of days ago, with the market looking like they were wanting a bit more from them. The market was impressed with Google's earnings, and that found new year-to-date highs today, but finished basically flat. Amazon kind of stalling out. We got their earnings this time next week as well. And the biggest gainer this year of the whole pack, NVDA, on a little bit of an inverted hammer pattern. Tesla falling the most out of all of them, down 3.2% and closing below its 50-day VWAP for the first time in a couple of months. And the winner of the day was Meta after their earnings yesterday, up 4.4%. But looks like investors took advantage of those high prices and sold it off hard straight from the open on volume. And it looks like Netflix is going into a short-term downtrend. And there's Tupperware again, meme stock, ripping up 56% today on huge volume. Looks like day traders got a hold of that one. However, the rest of the meme space, pretty weak out there. We've got AMC down 10% and a bunch of others down 7, 6, 5%. Out with earnings today was McDonald's, coming in with a 13% beat. Market seems to be holding up this stock pretty well. Also out with earnings today was Royal Caribbean Cruises, coming in with a 15% beat, and the market ripping up to another new year-to-date high, just under 110 a share. And just going out to a weekly chart on this one, I'll be looking to see whether we can get up into those 120s, 130s, and then potentially looking to get short this stock. As according to my stock fair value indicator, it is significantly overvalued by more than double. And I think it makes for a great hedge in the typical long-only portfolio, because when we see global events like the COVID or Russian invasions or anything else, who knows what's next around the corner, recession or anything, this is a really consumer-sensitive stock and travel stock. And I think shorting it at 120, 130 could potentially make for a good risk-reward. So we'll just have to wait and see whether we can get up there, back to that big resistance zone just before COVID hit. But so far, the cruise industry has been doing well this year. They are hitting record bookings and everything's going well. There's that big pullback after Chipotle's earnings yesterday. Still more weakness in Spotify. And those hit telecoms haven't been able to recapture their 50-day VWAPs as of yet. Kind of just bouncing off them a bit. And a bit of weakness in the financials out there today. And let's look at our S&P 500 oscillator, currently reading 57.45. Still on this massive bearish divergence from the market. And so I guess the question is will this bearish engulfing pattern play out? So of course, like any pattern or indicator, it's not 100% success rate. From historical backtest, I've seen patterns like this typically have like somewhere between a 56 to 58% chance of playing out. However, when you combine it with other things, you can increase those odds a little bit. And one of those things is we are hitting that resistance zone around 4,600 on the S&P 500. Now on the 5th consecutive reversal signal here we've got, and we are a bit overbought on the DSI at 12.37, which is the highest it's been for a couple of years. However, with all that, I would still put the odds of this playing out at about 60%. So that still leaves a 40% chance that this fails and we rip higher. And the big clues for that will be the VIX index. If that wakes up and gets back above 17 and towards 20. And the other big one to watch will be the core inflation rate. And so we'll really be looking for the August number. And the stock market is just expecting this to keep ticking down and down. So if we get a surprise uptick in inflation, that should really rattle the stock market and get bond yields ripping higher. As with the tight employment market and how elevated risk markets are, and the good growth in the economy, that gives Jay Powell plenty of room to do at least another couple more hikes if he thinks inflation might ramp back up. Because the last time we saw these levels of inflation was in the 70s, and it did initially hit a peak similar to what it hit this cycle, and then did proceed to come down for the next year or so. However, it didn't fall right back down to target in a linear way. It actually shot back up to another unexpected high in the mid-70s, causing huge weakness in the stock market and commodities, gold and oil to rip higher. Then after that second wave, and it started to come down, people thought it was surely done now. The Fed had got on top of it. However, there was another third and higher wave before it finally came down into the early 80s, and paired with really low stock market valuations made it really fertile grounds to invest in the stock market. And as we all know, stocks went on a tear pretty much for the next 40 years, with only a couple of bear markets in the early 2000s, the GFC and a quick one in COVID. So this is what the stock market's hoping inflation's going to do right here, but it better hope it doesn't swing back higher and surprise everyone. And then we all look back and say, well, the record inverted bond yield curve did get it right. And so like I've been saying, for clues on inflation, keep an eye on commodities. Because for pretty much the better part of the last decade, commodities have been in a downtrend, deflationary, and helping the cost of goods, the cost of our energy, transport, industrial production, the list goes on. However, we did see that big bump up in 21-22, which contributed a lot to that increase in CPI inflation. And then the pullback in commodities has helped inflation come down. And we can see that if I overlay the chart with the core inflation rate, we can see that correlation between commodities and inflation. And so commodities is a bit of a leading indicator, as CPI will lag behind that. And we can see that commodities have broken out this downtrend here on the monthly chart. There's a look on the weekly chart. And finally on the daily chart, breaking out, and especially that strength in crude. But crude does have a bit more work here to make a new high and call it an uptrend. But if crude were to start going back towards $100, it's kind of hard to see how that wouldn't put upward pressure on inflation, especially with a tight jobs market. So looking at the weekly chart at the S&P 500, we are very technically stretched and overbought here. A lot of reversal signals coming in, and that bearish engulfing pattern on the daily chart just may play out, especially if that next CPI report we get a couple of weeks in August comes in a bit hotter than expected. I think that'll be a catalyst for this year's biggest correction and pullback in the stock market. But so far in earnings season is doing pretty good. Companies are beating the low expectations, and we'll just have to wait and see where that CPI number comes in and whether we can get any clues looking at government bond yield price action up until then. That's it for today. Thanks very much for sticking with me, and I look forward to delivering you another video tomorrow to finish out the week. Cheers.